2 or 3 times a year. Well, even January 1st and on the 4th of July, make a list of everything you own, all the properties you own, and make a list of everything you owe. Accountants would call that assets and liabilities. Yep. Then subtract them, and that is your net worth.
Yep.
And or in common language, that's your wealth. Mm-hmm. And do track it. What gets managed, what gets measured gets managed.
Hey everybody, welcome back to another episode of the Richer Geek. I am happy and pleased to have Jeff Johnson. He's the author of the upcoming book, 1 Decade to Make Millions. And I think we're all hoping to do that. But, he's going to give us some scenarios. He's going to give us some examples that he has learned, through his career as a financial planner. And we're going to kind of dive into that and see what kind of things and different nuggets we can learn. How you doing, Jeff?
Dan, never better. Thanks a lot. Thanks for having me as a guest. I really appreciate the opportunity to share what I've been doing and about my upcoming book.
Well, let's talk about your beginning. Let's talk a little bit about you and where you've been and what you're doing now.
Sure. Well, I'm a country boy from Nebraska, and I got in the investment business in 1982, the day the market hit a low of 777, the Dow Jones average. So that kind of shares, it dates me a bit, but it's been a wonderful career. I worked basically as a stockbroker for 15 or 20 years, and then started my own firm, a private wealth management firm, which I managed and ran for about 15 years, and now have merged that firm 5 years ago into a national firm called Buckingham Strategic Wealth. So I've remained a partner and continue to be active, but we're able to turn over some of the day-to-day and some of the hard parts of being an entrepreneur over to people that do that all the time: hiring, firing, benefits, pension plans, and so on. So one of the things that in my career that's been a thrill is I was asked to teach a university class on financial planning and personal finance. And I said, I'm too busy. I can't do it. But the dean of business knew who I was, and he said, just teach it for a semester or maybe 2, and we'll find somebody to do it. And so they didn't find anybody else to do it. So I did it for 10 years. It was just an honor to teach young people, to the 20 somethings. And after I quit, because I wanted to spend more time just working with clients and teaching a class a couple times a week, in addition to my regular career, it took a lot of time. And as I get longer in the tooth, I want to work a little bit less. So I quit. I started getting calls from my former students that had my number or we were friends on Facebook, and they were having incredible success. And about a year ago, one of the students, who is now in his early 30s, said, "Hey, I got to tell you how I'm doing." I'm like, "Great." And I remembered him because he had an unusual name, an unusual last name, and he was an excellent student. So I always remembered that. And the bottom line was, he and his wife, they both took my class at different times, and they didn't know each other. But they're in their 30s, they had $700,000 accumulated, which just, warms my heart. Absolutely. And I said, what did you do? He said, I just did what you taught us to do in class. I started saving, and I started increasing my savings, and I invested wisely. And, this guy's going to have several $1 million by the time he's 40.
Yeah. And that's fantastic. So, let's kind of stick on the early 20s and some of the younger people. Sure. I'm starting to see a couple things. I'm far removed from, the Z and the Gen Zs and whatever the different ones of the younger people, and they seem to not spend a lot, so I think they're doing a lot that are kind of like, well, because they've never been able to afford to. But I'm seeing different things where, well, should they even save it all? And then the financial planners like you are saying, well, wait a minute, you need to start saving now. What's some of the things that you've actually taught some of these young people, and what you would teach specifically people in their 20s now?
Sure. So in this book called One Decade to Make Millions, and that decade, by the way, is the decade of your 20s. That's really where you get a leg up, and I could tell you some stories around that as well. But it's the importance of understanding compounding. Now, I feel like your listeners are probably a leg up with the rest of the world in understanding interest rates and understanding mathematics. And if you understand compound interest and you just get a calculator and can spend a little time playing with the numbers, you realize that when you save over 40 or 50 years period of time rather than 20 or 30 years, that the results are magnified. And the only way you can do that, unless you're going to live to and work till 100, is to get started when you're in your 20s. And it does not have to be insane amounts of money either. It can be reasonable amounts. I mean, I always teach in my classes, or used to teach, spend some, save some. But the important part is make sure you do save some, and you don't do anything really crazy with it. That doesn't mean you can't have some fun. It just means you can't spend it all. Yeah. And there are a great many people in across America that do that, and they do that until they get to be in their 50s, and then they come to me or someone like me and say, I'd sure like to retire when I get to be 60. And I'm like, well, how much have you accumulated? Well, none. I make a lot. I'm like, well, you're gonna have to really save a lot.
Yeah,
they have to adopt a plan B.
It's sad, when you see people in their 70s, working as cashiers or working for different things. You're just like going, man, I just do not want to be that person. And I think it is very very smart what you're doing. And how about like accumulating debt? It's some people teach us like, look, you can't buy it, don't if you can't afford it, don't buy it type of a deal.
Yeah, well, I would like to think that we could get through life without having any in debt, but I don't think that's realistic. I think some of your listeners probably very high income at an early age, and probably could if they lower their cost of living, and instead of buying an enormous house and instead of buying $250,000 cars, lived a more modest lifestyle. Yeah, they could probably be debt free early on. And I think that's wonderful. I know in my life I couldn't do that, and most of the people that I taught in college classes couldn't do that. But it's important to have the right kind of debt if you're going to have it. I think there's a big difference between good debt and bad debt. Bad debt is used to buy something that is of diminishing value or no value whatsoever. It's like it's borrowing to take an exotic trip, $25,000 or $50,000, and I've seen people do that. And then when it's gone, you still have the debt, but the travel's over. Better to pay cash for that. Good debt would be owning, buying property, buying a house that can appreciate in time, or at least lock in your costs if you're in a rising, escalating market, or buying any kind of commercial investment property that is going to be valuable. I think that's a really smart thing to do. One of the big benefits of being a real estate investor, and again, let me caveat that with, I'm not a professional in the real estate markets, but I've been an observer for 40 years. And one of the beauties of real estate is it's a permanent asset. You can leverage it. You can get attractive financing at times, and the financing costs exceed or lower than the revenues generated. That's calling getting the wind at your back. When you're making more than you're spending and your investments return more in cash flow than the costs of the property, you've got two engines firing, making you wealthy.
That's right. Yeah. And I am a professional real estate investor. That's what I do for my full time. And I've always said that, you can leverage things that make you money. Yeah.
And so I do think that's smart. There are investments like in the equity and stock markets, which is what most of my investment dollars for my clients have been, and myself. A little leverage can work for you, but oftentimes for non-professionals, it doesn't work very well. So, and I'm reminded of from Hamlet. Polonius, I think was said, neither a borrower or a lender be. And if that's the case, you wouldn't borrow money, and you'd own only equities. Well, again, I don't think that's realistic today. But if you're borrowing money and using it in a constructive way.
Mm-hmm.
I think that's smart. The other side of it is, if you're a really high income individual and the cash flow is coming in, you don't really have to have outsized returns either. You can get good average returns from owning a broadly diversified stock mutual index fund, and probably average over a long period of time high single digits or even 10%. I think historical numbers would support my statement.
Mm-hmm.
And if you're making a high single digit number and you're pouring a lot of money into your account, you don't have to do anything crazy. You don't have to take undue risk. You don't have to spend any extra time managing it. So,
Mm-hmm.
it really comes down to, as a financial planner, I tell people the first thing to do is figure out, what do you really want to achieve? What's really important to you? Forget about thinking about what other people think about you. You don't have to drive a certain car or have a certain purse or wear certain clothes. Unless you want to, that's fine. But if you're doing it because you think of what somebody else's opinion, that's probably not a way to be happy.
Mm-hmm.
So think about what you really want to achieve and what would really make you happy, truly make you happy. And that's sometimes hard for people to do. And I will tell you, most people in America today are random. They live a random life. They go to work. They have some sort of goals. They want to send a kid to college and they want to remodel the upstairs and that kind of thing. But they don't have real intentional goals about what they want to achieve. And that is one of the things that I do with people professionally is help them think about that. But our listeners today should just think about that. Number one, figure out what you really want to achieve. What is it really that's important to you? And then get started. It is, the plan doesn't have to be perfect. The execution needs to be good. But I think Jamie Dimon was credited with either saying or repeating, I'd rather have a mediocre plan that's executed perfectly than have a perfect plan that's not executed.
Mm-hmm.
So get your plan. It doesn't have to be perfect, and get to work and start saving.
Now, in your book, ladies and gentlemen, it's 1 Decade to Make Millions. You talk about the strategies. What are some of the strategies that people can think about and utilize that you could tell them, people that are in their 20s?
Sure. Thank you. And this is a strategy. What I'm going to tell you about is not a guarantee to make money. And it's definitely not in the short run, but it's called dollar cost averaging. And in this approach, rather than trying to pick bottoms and avoid tops, the investor just makes investments of a fixed amount. Let's say monthly, whether it's $200 a month or $20,000 or $100,000 or whatever the amount is. If you set up a plan to invest when market values are higher, you buy less shares, and when they're lower, you end up with more shares, bringing you in at a lower average cost. It's called dollar cost averaging. And you can do searches online and find all kinds of definitions, but that's the basics of it. And in my book, I tell the story about a young woman that called me now about 40 years ago. I didn't really know her, but she was a friend of a friend. She didn't really have any money, so I needed to get clients that could pay me. So I said, I'll help you. And we did it over the phone. I never met her. And I helped her sign up for her 401k plan. She goes, well, I'm not very good with money. Well, about 4 or 5 years later, she calls and says, something's wrong. Do you remember me? And I kind of vaguely remembered her. And she said, something's wrong. And I thought, okay, well, what? She goes, I need to bring this statement in. Well, she had invested like $10,000 or $15,000 over a period of a few years, but it was worth $25,000. She said, something's wrong. Well, this had been a gain, and through ups and downs. She goes, okay, well, no problem. Well, I didn't hear from her again until about a year and a half ago. She was 62 years old. And she says, I never really looked at this account because I know I'm not very good with money. It was $2 million. And she was not in a high paid job. She worked for a financial company, and the same company. And she said, I was married and divorced a couple of times, and I spent all the rest of my money, but all this money's in this 401k plan. And she just kept putting the money in for 40 years. I think it was like 38 years.
Wow.
And I called her, that's from dollar cost averaging.
Yeah, absolutely. And especially if your company does matching.
Yeah.
I mean,
right.
that's free money, right?
Yeah. Yeah. If you stay with the company for a period of time. Yeah. Yeah. So I think that's a strategy that just about anybody can implement over a period of time. having a long-term view is absolutely important in stocks because the whims of the market, which we're experiencing now, this this recording is in October and in October of 2022, and we're going through a really difficult time price-wise. But
that's when you buy.
If you have a long-term perspective, if you're doing dollar cost averaging, you just keep putting in the same amount, you're buying more shares than you were before. It's not a guarantee that you're going to make money, and it's definitely not a guarantee you're going to make money in the short run. But people that have done this over the last this last century have done pretty well.
Mm-hmm. Yeah, it amazes me sometimes when I see that, and I see it in real estate also, when it's starting to crash, it's starting to go down, people panic
Right.
and sell. And that has never, ever made sense to me.
Right.
A lot of us have made, most of our money or a lot of our money when things are down.
Of course. Well, you can definitely make it faster if you step up and you make timely investments that way, because you're buying it with plenty of room on the upside.
Yeah, and we know with trends, things will recover. It may not be for another 2 years, might not be another 5, might be next year. I mean, you don't know. But history and trends have told us that real estate and the markets will recover, and I think that's an important reason why people should diversify.
Something else, let me share that I don't cover it in the book, but it's an exercise that smart people that want to do a little research that they can make as a foundation for their thinking. Look back at the history of market returns. You can find it online. Anybody can find it. Or a favorite old mutual fund, whatever. And look at the average annual returns each year going back for decades and decades. Then put that into a spreadsheet and look at what rolling 10-year periods look like. Look at every individual 10-year period. Okay, you're going to find a range of returns there. You're going to have some 10-year periods where you actually didn't make very much money for over 10 years. Like, for example, the 70s would be a good example of that. And there's going to be periods of time where the returns are absolutely outsized, which would be like the 80s and the 90s. Mm-hmm. Then look at 20-year rolling periods. Now that band of returns tightens up a little bit. The highs aren't as high, the lows aren't as low. And then do it for 30 years and do it for 40 years. And pretty soon those average returns really narrow in. And I'm going to, I think what our listeners would find if they did that is long-term returns are high single digits to 10 or 11%, depending on the index, depending on the fund. But it doesn't break down in individual years. In fact, there's very few years that end up being high single digits or 10%. They're usually much, much more or much less. So that adopting that long-term foundational knowledge about it gives me comfort and my clients comfort that we can make investments. We don't like it when they're down, but if you make long-term investments and you know what the results are going to be over a long period of time, it's a good way to accumulate.
Now, what do you tell 20-somethings that are listening to this? They've made some major financial mistakes. They've 5 years into it, they've cashed out their 401k, or they've taken loans, or they've just high debt to income, and they're like going, I don't have the money. I can't do this. What do you tell? How do you tell them that they can bounce back?
Well, it certainly can, because they have lots of years, and they definitely have earning power, and that should grow for a number of years. But probably need to take a look at maybe a plan B. Maybe look at what their costs are. I know certain areas of the country have incredibly high cost of living, incredibly high home prices, and I don't know how to deal with that except to say, is there any way that you can have less money invested in residential real estate? Because I think that is money that is, unlike the investment properties that you and I talked about, I mean, in this broadcast and even earlier. Investment properties is a different thing, because the more assets you have there, the more that your return should be. But everybody makes mistakes. I mean, everybody makes mistakes, and so don't kick yourself too hard. Just learn from it and move on.
Yeah.
I'll share a book. The Road Less Stupid is a favorite book of mine. If you know this book. it's an incredibly good read, and it's good for anybody. It's about business and owning a business property, but it's also good just to learn to be intentional and really think through what you want to do. And I think that book, Keith Cunningham is the author of The Road Less Stupid. It's a book worth buying today. And I made it part of my personal annual MBA program. I read 20 books or so and reread them every year. I'm not smart enough to remember them all, remember everything in them. And I go through and I highlight them in a different color every year. So now that book is almost completely highlighted in 5 or 6 different shades.
Yeah.
But we all make mistakes.
Yeah. And one of my favorite books that I've got probably 100 tabs in, it's called Money Secrets of the Rich.
Okay.
It's by a friend of mine named John Burley. And it's kind of along the same way. It's like, look, here's what the truly rich are doing and how they're not being stupid.
Yeah.
And here you are paying $10 for your coffee and,
yeah,
and doing things like that you can be a little more smarter about. And that's really something. So what's more important? So you've got this 20-something, made some bad problems, bad, financial mistakes, getting your credit score up to a good place or building up your savings, or both.
Well, I think they're both super important. The credit score is really, really vital for everything anymore, for, just your insurance rates, for, and you have to build that back. But it doesn't have to be super high. It doesn't have to be 820 or whatever the top end is, but his needs to be reasonable. But having some wood in the shed, the basis in this book is the basis for all my teaching of the young people is called the 5 financial foundations. And here they are. Always save money. Every time you get some money, whether it's earned or whether it's, from your late aunt or, for whatever it is, if you're a bartender and a server, or whether you get it by paycheck, save some money every time you get it. It doesn't have to be all of it. Have a cash reserve. I call it having wood in the shed. I'm a country boy, have some reserve, because it takes the pressure off of we live a life of pressure in the U.S., in modern America. The third thing is maximize your retirement plan. And if you're young, have it mostly or all invested in equities. And, I would prefer an equity index fund. Number 4 is have the right size house, the right size, the right price house. Really important. And sometimes well-meaning people, real estate people and well-meaning relatives will say, buy the biggest house you can afford and start getting equity buildup. Well, I can see where it looks like that's what it is. But, with the really large house comes higher property taxes, higher insurance, more furniture you got to buy,
utilities,
carpets and the drapes and the utilities and the landscaping, is 2 or 3x what it would be if you had a smaller, more comfortable, a comfortable home that just costs less. So that's a big deal. And the last thing is no bad debt. If you can eliminate your bad debt and have only good debt, low cost, tax deductible, that's used to accumulate things that will help you gain wealth, gain income, gain assets, as opposed to just spending on things that are meaningless.
Yeah. I know some young people that live in apartments but have 5 rental houses.
Yeah.
And they themselves live in an apartment. And I'm like,
there you go.
There you go.
Smart thinking.
They live in a duplex.
Yeah.
And rent out the one side.
Yeah.
Just smart thinking. I
know, I could, again, I'm not a professional in the real estate business, but many of my clients have also owned real estate. And so I've been able to be an observer of what they've done. And one client just did exactly that. He was in real estate. He bought a duplex. He still owns it. And he's, in his 60s,
And that depreciation really, really helps. That's the other part that you can teach people.
Yeah.
Within your financial plan is, if you make a lot of income and you have a lot of taxes, if you diversify into some real estate or into something that has depreciation.
Yep.
That's really good. So what else can we talk about with your book? Some other, some tidbits.
I really love the concept of getting the wind at your back, the financial wind at your back. And that's, you have 2 engines. One is, when you're earning more than you're spending. Benjamin Franklin is credited with saying, the way to have wealth is to learn to diminish your wants or augment your means, but preferably both. And if you get that, that's one engine that's working for you.
Yep.
The second is get your investments working for you and get that working as soon as possible. Then you have two engines, and that's when you really have an acceleration of your net worth. I would be a proponent of learning how to make a simple net worth statement. It doesn't have to be what an accountant would do, but 2 or 3 times a year, well, even January 1st and on the 4th of July, make a list of everything you own, all the properties you own, and make a list of everything you owe. Accountants would call that assets and liabilities. Then subtract them, and that is your net worth. And or in common language, that's your wealth. And do track it. What gets managed, what gets measured gets managed. And even if you don't have really strong financial goals, I think this is a useful tool that I try to get my students to do on a regular basis, and I try to have clients do this. Sometimes I have to do it for them, and I'm happy to do it. I think that's a really powerful tool for our listeners if they haven't been doing that to do the tracking.
Yeah, that's really important, and luckily for me, I have the banks that make me do it every year.
Yeah,
because they want to know where I am. If they're lending me millions and millions of dollars and things like that. So it is surprising. You're like, wow, okay. It's a very nice exercise, and I agree with that. So what are some of the in your book? There's a lot of stories that you have.
Yeah.
Just give us one that you were most surprised by in regards to like how much they were able to save. Anything else, other than the 2 stories you just told us?
Sure. Well, one of the stories is the Barry the bartender. This is a real story. He was in my very first class, and he fell asleep in the middle of class for the first several weeks. And I thought, I was a new teacher, and I thought I must really be a poor teacher. So I asked him after class, stick around, and he was, he knew I was going to ask him what the deal was, but turns out he was a bartender. He was in a college town, and he was working almost every night. And bars closed at 2:00. He had to clean up, so he didn't get home till 4:00. And he had another part-time job on campus. And by the time my 3:00 class rolled around, he was spent. So I said, "But do you want to be in this class, or do you want to drop and add something else?" He's like, "No, I really want to stay in the class, but I just couldn't stay awake." And I had started with a stupid rule and said, "No coffee and candy and that stuff. We're here to learn." So I scrapped that. I said, "You move to the front row, and you bring a great big steaming coffee with you." And he was not a great student. He was not a A+ student, but he learned a lot. And we talked after class, and he had questions because he had this cash flow. Turns out he also was mowing lawns, and this was in Lincoln, Nebraska. So he was removing snow in the wintertime. And so he asked questions, and we stayed in touch lightly through social media. Then one day he messages me and says, "Could I come into your office? I need some help." And I'm like, okay. Well, he had saved a really good 6-figure amount before he was 30. And this was a C student. And he had accumulated this money, and he's continued on. I helped him set up an investment account, and he's going to be a multimillionaire by 40. And he has what I would describe as a good job, but nothing stunning. But he's going to have choices in life. He's going to be able to educate his children, live in a comfortable home, and made some other, they made some other life choices. He and his spouse, his partner, and I'm thrilled by that. And that was really before I was what I thought was as a good teacher. So as I think about our listeners today, even if you haven't started saving or don't really have a program, just get started, because savings is a muscle similar to like a physical muscle. If you go to the gym and you haven't been for years, and you try to do a huge workout, you're going to be sore and you're going to hurt yourself, and maybe it won't be back for weeks or weeks. Start with a light workout. Makes sense, right? Go for an easy run or walk around the block rather than trying to run 5 miles. It's the same with savings. Just start. If you're a bartender, save $1 or $5 or $10 every time you work. If you're in a professional career and you have extra cash flow, take an amount that you can stick to and get started, and then you can increase it from there. So the plan doesn't have to be perfect. It just needs to get some execution. And when I've told people to do that, and they said, "Oh yeah," then I got better at it. Yeah, you will get better at it. So
Yep.
that would be my advice for our listeners.
Jeff, that's some great things that you're saying, some inspirations and just the stories, and a lot of great advice. We appreciate it. How can people find you if they're interested in learning more?
Sure. I have a website. It's my name, jeffcjohnson.com. My book is for sale on Amazon, 1 Decade to Make Millions. I think the paperback is $15 and the ebook, and there's Audible as well. They're not super spendy, but a lot of practical advice. I have really good editors and publishers that help me thin down some of the extra. I know my readers are mostly young people that don't want to have a 300-page book on how to. And so this is a 2 hour, maybe a 2 to 2.5 hour read. It also goes through in the very last chapter, how to choose a financial advisor, which I think is a super big decision. More important maybe than your investments is understanding who your advisor should be. Put as much effort into choosing who you work with and get your advice from, and making sure that's a right fit. Make sure it's somebody that's a fiduciary that's required to look out for your best interests. Make sure you get the right kind of engagement, which could be an ongoing engagement, which is what I do for clients. Maybe starting out, you don't need that. Maybe you just need somebody to help you, and you can pay them, a set amount to just help you get started on a one-time engagement, and get that started, and just get it kicked off. That's what I'd be thrilled to find out, in a year or two, that somebody that listened to this program really took it to heart, and it really made a difference in their life.
Absolutely. Well, Jeff, I appreciate it. Our time's coming to an end. Thank you so much for coming on the Richer Geek. Everybody, again, it's Jeff Johnson. Get on Amazon, 1 Decade to Make Millions. It's a strategy to maximize the power of your 20s. And I would still do it if you're in your 30s or 40s, or even me, older than that. But thank you, Jeff, and take care. Thank you for coming on.
Thank you. Thanks for the opportunity.